Welcome to the Deep Dive, the show that takes your sources, cuts through the noise, and extracts the most important nuggets of knowledge to get you well-informed, fast. Today we have a really focused mission. We're diving deep into general auditing principles and auditors' responsibilities. This is really geared towards helping you prepare for an upcoming exam. Think of us as your expert guides, navigating this critical material with you. We want to help you not just memorize, but deeply understand and truly retain it so you can apply it effectively during those challenging, case-based exam questions.
Precisely. We'll be navigating a core chapter on auditing principles, and alongside that, some key standards on auditing the essays.
Right, the essays.
Think of these essays as the official rulebook, the guidelines for auditors. They're issued by professional bodies, and they ensure audits are done consistently, effectively, worldwide. We'll specifically hit SA 200, SA 240, SA 250, SA 260, SA 299, and SA 402. Our goal for you today is a really comprehensive review. We'll be using the same language, the same terminology you'll find in your source material. That familiarity is key for exams. And we'll explain how these concepts apply in real-world exam-style scenarios, integrating them into descriptive case studies. So let's unpack this.
Okay, let's start with laying the foundation, the core principles of auditing. Beginning with SA 200, the overall objectives of the independent auditor. What's the auditor's ultimate goal here?
Okay, so SA 200, this really sets out the auditor's main goal.
The core objective.
Exactly. It's about getting what we call reasonable assurance. Assurance that the financial statements, as a whole, are free from material misstatement.
Material being the key word there.
Absolutely. Whether it's from fraud or just, an error. And reasonable assurance. What's that actually mean for you, say, in an exam scenario? Well, it's a high level of assurance.
High, but not total.
Precisely. Not absolute certainty. Because while auditing isn't perfect, right?
Yeah.
There are always going to be inherent limitations of an audit.
The inherent limitations. We hear that phrase a lot.
We do, and they're crucial. It means there's always some risk, even with a well-performed audit.
Okay. And to even aim for that high level of assurance, the auditor needs a particular way of thinking, right? A specific mindset.
Yes, definitely. Two key things here. First, professional skepticism. That's huge.
So not just taking things at face value, more like a questioning mind.
Exactly. Not being cynical, but having that questioning mind throughout the whole audit, critically assessing the evidence, not just accepting it.
Almost like being a detective.
Sort of, yeah. And the other key element is applying professional judgment.
Ah, okay.
That comes into play in, all aspects of the audit, from the planning stages right through to forming the final conclusion.
So it's about using their experience and discernment, not just following a checklist blindly.
You got it. Think of it like a doctor using guidelines, but also their own experience to diagnose effectively. And tied right into this is the concept of audit risk.
Audit risk. Okay, what's that?
It's the risk that we, as auditors, might express an inappropriate opinion. Meaning we say the financial statements are clean, they're fairly presented, when actually they're materially misstated.
Oh, okay. That's the big one you want to avoid.
Absolutely. And audit risk itself is a function of, a couple of things. First, there are the risks of material misstatement. These exist within the company itself, things like inherent risk and control risk. They're there regardless of the audit. And second, there's detection risk. That's the risk that our own audit procedures fail to catch a material misstatement that exists.
So it's a combination of the company's risks and the auditor's risk of missing something.
Exactly. And underpinning all of this is the idea of materiality.
Right, materiality. What's considered material?
It's basically anything that could reasonably be expected to influence the economic decisions of someone using those financial statements.
So if an error or omission is big enough to make an investor change their mind, for example, then it's material.
Precisely. That's the threshold we're concerned about.
Okay, so if reasonable assurance is the goal, how do auditors even start a relationship with a client? It can't just be a handshake, right? This must be where SA 210 comes in, agreeing the terms.
Exactly. SA 210, agreeing the terms of audit engagements, this is foundational. Before we even think about starting the audit work, we need to make sure certain preconditions for an audit are met.
Preconditions? Like what?
Well, first, we need to ensure the applicable financial reporting framework the company uses, like GAAP or IFRS, is actually acceptable for their circumstances.
Makes sense.
And critically, management and sometimes those charged with governance think the board or audit committee they must acknowledge and understand their responsibilities.
And what are those responsibilities specifically?
They're quite detailed. Management is responsible for the preparation and presentation of the financial statements, free from material misstatement, whether due to fraud or error. That's their job, not the auditor's.
Okay.
This includes designing, implementing, and maintaining their own internal control systems to prevent or detect misstatements.
All right.
And, very importantly, they have to commit to provide the auditor with unrestricted access to records, information, and people within the entity that the auditor needs to get evidence from.
Wow. Unrestricted access. That's key.
Absolutely. Without these preconditions, especially management accepting their role, a proper audit just can't happen.
That's a really comprehensive list of responsibilities for management. It highlights how much needs to be in place before the auditor really gets going. So once those preconditions are met, responsibilities are clear. How is it formalized?
It's formalized in the engagement letter.
Ah, the letter.
Yes. This is the written agreement. It nails down the objective and scope of the audit. It clearly states the responsibilities of the auditor. And, crucially, it reiterates the responsibilities of management that we just discussed.
So it's basically the contract for the audit.
Yeah.
Sets the ground rules, protects both sides.
Exactly. It manages expectations right from the start. Now, this raises an important question. How do auditors actually capture all this work? All the procedures, the evidence, the judgments?
Good point. There must be a record.
There has to be. And that brings us to SA 230. Audit documentation. This is absolutely critical. Think of audit documentation as the auditor's complete logbook, their blueprint for the engagement. The standard defines it as the record of audit procedures performed, relevant audit evidence obtained, and conclusions the auditor reached.
So it's not just keeping papers, it's about telling a story. A clear, traceable story of the audit.
Precisely. It serves a dual purpose. First, it's the evidence of the auditor's basis for a conclusion, why we issued the opinion we did. And second, it's evidence that the audit was planned and performed in accordance with SS and other legal requirements.
And how detailed does it need to be?
The standard is clear. It must be sufficient to enable an experienced auditor, having no previous connection with the audit, to understand the work done, the evidence obtained, the significant matters, and the conclusions reached.
So someone else could pick up the file years later and follow the whole thing.
That's the benchmark. Imagine a new auditor taking over or a regulator reviewing the file. They should be able to understand it without needing to ask you questions.
That makes a lot of sense. Accountability.
Exactly. And key aspects of good documentation include timely preparation.
Meaning do it as you go, not months later.
Yes, document the work as it's performed or shortly thereafter. Memories fade. It also needs to record the identifying characteristics of the specific items or matters tested. So not just tested invoices, but which invoices.
The specifics.
And clearly state who performed the work and when, and who reviewed it and when. That audit trail is vital. Plus, any discussions of significant matters with management, those charged with governance, and others must be documented. Who, when, what was discussed.
Keeping track of those important conversations.
Absolutely. And there's a specific point, too. If, in rare exceptional circumstances, an auditor needs to depart from a relevant requirement in a SA.
Which sounds like something you wouldn't do lightly.
Definitely not. But if they have to, they shall document how they departed, the reasons why, and what alternative audit procedures they performed to achieve the objective.
So full transparency, even in exceptions.
It's all about creating that robust audit trail.
Okay, foundation laid. Now let's bring these principles to life. Let's dive into the area of fraud with SA 240. This is often a big focus in exams, right?
Absolutely. SA 240, the auditor's responsibilities relating to fraud in an audit of financial statements, it's critical.
So let's use a scenario, like the ones you might face. Imagine you are CAB Joy, the auditor of a listed company. For the last 3 years, everything seemed fine. You issued clean, unmodified opinions. But now, allegations are swirling in the media.
Okay, this is where an auditor's pulse starts to quicken.
Exactly.
Yeah.
What are the allegations against CAB Joy's client?
The core allegations are serious. Things like flouting of securities contracts, regulation, rules by clandestinely controlling more than required percentage of shares.
Wow.
Also, manipulating share prices, artificially keeping share prices high, and a failure to disclose all related party transactions. These are major red flags.
And the regulators are involved?
Yes. SEBI, the Securities and Exchange Board of India in this example, is seized of the matter on its own. They're investigating.
So CAB Joy is in a tough spot.
Definitely. Because the regulatory report would take time and audit has to be completed within timelines.
The pressure is on. Audit deadline versus a potential massive issue.
Right. And the conclusion is clear. There seemed to be a heightened level of audit risk.
So if you're CAB Joy, you have this huge cloud of potential fraud hanging over the audit, but you still have deadlines. What do you do? How does SA 240 help?
Well, first, let's be clear on what fraud actually means in this context.
Okay.
SA 240 defines it as an intentional act by one or more individuals among management, those charged with governance, employees, or third parties, involving the use of deception to obtain an unjust or illegal advantage.
Intentional being the key word again. It's deliberate deception.
Exactly. The crucial distinguishing factor between fraud and error is whether the underlying action is intentional or unintentional. Errors are mistakes. Fraud is planned deceit.
And for auditors, there are two main types of intentional misstatements they're primarily concerned with, right?
The first is misstatements resulting from fraudulent financial reporting.
Often called cooking the books, making the company look better than it is.
That's a common way to put it, yes. Manipulating the numbers. The second type is misstatements resulting from misappropriation of assets.
Which is basically theft, stealing from the company.
Correct. Both can lead to material misstatements, so auditors need to consider both. And typically, fraud, whether it's cooking the books or theft, involves three conditions, often called the fraud triangle.
The fraud triangle. Okay, what are the three sides?
First, there's an incentive or pressure to commit fraud, some reason why someone would do it. Second, there's a perceived opportunity to do so. They see a way they can get away with it, maybe due to weak controls. And third, there's some rationalization of the act. They find a way to justify it to themselves.
Can you give examples?
Sure. For fraudulent financial reporting, an incentive or pressure may exist when management is under pressure to achieve an expected and perhaps unrealistic earnings target.
Like pressure from analysts or the board?
Exactly. The opportunity might be weak internal controls over revenue recognition and the rationalization. Maybe they tell themselves, it's just temporary, we'll fix it next quarter, or everyone does it.
Okay, that makes sense. Incentive, opportunity, rationalization. So focusing on that first type, fraudulent financial reporting, how might a company actually do that? What are the common methods used to inflate numbers or manage earnings?
It involves those intentional misstatements, including omissions of amounts or disclosures in financial statements to deceive financial statement users. Common methods: outright manipulation, falsification, including forgery or alteration of accounting records or supporting documentation.
So literally changing documents or creating fake ones.
Yes, or it could be misrepresentation in or intentional omission from the financial statements, hiding bad news or lying about good news, or even the intentional misapplication of accounting principles, deliberately choosing the wrong accounting treatment to get a desired result.
And how do they often get away with this, especially if there are controls?
That's where management override of controls comes in. This is a huge risk area. Management is often in a position to bypass controls that might stop lower-level employees.
How they override?
Techniques can include recording fictitious journal entries, particularly close to the end of an accounting period, to manipulate results.
Those late-night entries.
Exactly. Or inappropriately adjusting assumptions and changing judgments used to estimate account balances, like bad debt provisions or inventory obsolescence.
Tweaking the estimates.
Right. Also, concealing or not disclosing facts that could affect the amounts recorded, and engaging in complex transactions that are structured to misrepresent the financial position or financial performance, making things so complicated they're hard to unravel. Auditors need to be constantly vigilant for these signs of override. Then there's the other type, misappropriation of assets. Yes, the theft of an entity's assets. It's often done by employees, but management can do it too, and they're usually better at covering it up.
What are some concrete examples an exam might throw at you?
Things like embezzling receipts, for example, pocketing cash from customer payments before it's recorded. That's classic misappropriating collections on accounts receivable. Or stealing physical assets or intellectual property. Think stealing inventory for personal use or sale, or even stealing sensitive data.
Okay.
Another one is causing an entity to pay for goods and services not received. This could involve setting up fake vendors, payments to fictitious vendors, or processing invoices for goods that never arrived.
Paying ghosts?
Pretty much.
Wow.
And also using an entity's assets for personal use, like using company funds for personal expenses, or using company property as collateral for a personal loan.
And presumably they try to cover this up too.
Oh, absolutely. Misappropriation is often accompanied by false or misleading records or documents, designed to conceal the fact that assets are missing or have been improperly used.
Okay, so the auditor's job is to get reasonable assurance that the financials aren't materially misstated by either fraud or error. But you mentioned those inherent limitations earlier. How do they really impact detecting fraud specifically? That sounds incredibly challenging.
It is. It's the core challenge with fraud detection. Because of those inherent limitations of an audit, there's always an unavoidable risk that some material misstatements may not be detected, even if the audit is perfectly planned and performed according to standards.
And fraud makes that risk even higher.
Much higher. Because fraud often involves sophisticated and carefully organized schemes designed to conceal it. Think forgery, deliberate failure to record transactions, collusion between multiple people, or intentional misrepresentations made to the auditor. People are actively trying to hide it.
Right.
And critically, the risk of the auditor not detecting a material misstatement resulting from management fraud is greater than for employee fraud.
Why is that?
Because management is often in a position to directly or indirectly manipulate accounting records, present fraudulent financial information, or override control procedures. They have the authority and access to bypass the systems designed to prevent or detect fraud by others.
Which brings us back to that need for constant vigilance, that professional skepticism throughout the audit, considering the potential for management override of controls. It's not a one-off check, it's continuous.
Absolutely continuous. It's an active mindset. And to help maintain that mindset and identify potential issues, auditors actively look for fraud risk factors.
Red flags, essentially.
Exactly. Events or conditions that suggest an incentive or pressure to commit fraud or provide an opportunity to commit fraud. They don't prove fraud exists, but they indicate areas needing closer scrutiny.
Can we look at some examples, maybe for fraudulent financial reporting first?
Sure, under incentives pressures. A big one is when financial stability or profitability is threatened, maybe due to intense competition, declining margins, or consistent operating losses.
Survival pressure.
Right. Or excessive pressure for management to meet the requirements or expectations of third parties, like hitting overly optimistic profitability or trend-level expectations of investment analysts, or the desperate need to obtain additional debt or equity financing just to keep operating.
External pressure.
Sometimes it's personal, too. Information available indicates that the personal financial situation of management is threatened by the entity's performance. Maybe their bonuses or stock options are at risk.
Okay, those are the why. What are the how, the opportunities?
Opportunities for fraudulent financial reporting might arise from things like significant related party transactions not in the ordinary course of business. These can be used to disguise things.
Related parties always need extra attention.
Definitely. Or when assets, liabilities, revenues, or expenses are based on significant estimates that involve subjective judgments or uncertainties that are difficult to corroborate. Lots of room to manipulate subjective estimates.
Like those provisions we mentioned.
Exactly. Also, watch out for significant, unusual, or highly complex transactions, especially those close to period end. They might be structured to obscure reality.
The year-end rush.
And significant operations located or conducted across international borders and jurisdictions where differing business environments and cultures exist, that can make oversight much harder.
Okay, incentives, opportunities. What about the third part? Rationalizations or attitudes?
Attitudes rationalizations can be signaled by things like ineffective communication, implementation support, or enforcement of the entity's values or ethical standards by management. Tone at the top matters.
If leadership doesn't care about ethics, why would anyone else?
Precisely. Or non-financial management's excessive participation in or preoccupation with the selection of accounting policies? Why is the sales director dictating accounting rules? A known history of violations of securities laws or other laws and regulations is obviously a major red flag, as are frequent disputes with the current or predecessor auditor on accounting, auditing, or reporting matters. Constant arguments can be a sign of trying to hide something, or just unreasonable demands on the auditor, such as unrealistic time constraints. Trying to rush the audit might be an attempt to limit scrutiny.
That's a lot of potential red flags just for fraudulent reporting. What about for misappropriation of assets?
For misappropriation of assets, the opportunities often relate to the nature of the assets themselves. Are they susceptible to theft?
Like what?
Things like large amounts of cash on hand, easy to pocket, or inventory items that are small in size, of high value, or in high demand. Think electronics, pharmaceuticals.
High value, easy to walk away with.
Exactly. or easily convertible assets, such as bearer bonds, diamonds, or computer chips. Things quickly turned into cash. Even fixed assets, which are small in size, marketable, or lacking observable identification of ownership. Small tools, laptops, etc.
And opportunities also come from weak controls, right?
Absolutely. Inadequate internal control is a huge opportunity factor. Things like inadequate segregation of duties or independent checks. If one person controls everything, it's easier to steal and cover it up.
Segregation of duties is key.
Critical. Or inadequate oversight of senior management expenditures, such as travel and other reimbursements. If no one checks the boss's expenses, well.
Yeah, that puts the detective hat firmly on the auditor, doesn't it?
Yeah.
I remember hearing about a case where a sudden, unexplained jump in sales right at year-end was the first real indicator something was off. Those unusual transactions really can stand out.
They really can. Those patterns, or lack thereof, are key. So, given these risks, auditors need specific responses to the assessed risks of material misstatement due to fraud. It's not enough just to identify them.
What are the key responses?
Well, a crucial one is the discussion among the engagement team. The whole team needs to brainstorm how and where the entity's financial statements may be susceptible to material misstatement due to fraud.
Pooling knowledge and experience.
Exactly. And this discussion must explicitly consider the risk of management override of controls. That risk needs to be front and center.
And are there specific procedures mandated by the standards to address that override risk?
Yes, SA 240 requires specific procedures. For instance, auditors must test the appropriateness of journal entries recorded in the general ledger and other adjustments, especially those made late in the period or at period end.
Looking for those suspicious entries.
Right. Looking for entries made to unrelated, unusual, or seldom used accounts, entries with round numbers or consistent ending numbers, entries made by people who shouldn't be making them.
Okay.
Auditors also need to review accounting estimates for biases. Look for patterns suggesting management is consistently pushing estimates in one direction to achieve a target.
Checking for management bias in subjective areas.
Yes, and they need to evaluate whether the business rationale or the lack thereof of significant transactions suggests that they may have been entered into to engage in fraudulent financial reporting or to conceal misappropriation of assets. Basically, does this complex deal actually make business sense, or is it just there to hide something?
So, digging behind the numbers to the why.
Exactly. These are concrete steps to take when that fraud radar is activated. Let's apply this. Think about that scenario from your study material, My Decor Limited, in Test Your Understanding 1.
Okay.
Situation is, the company's revenue has increased in financial year 2022-23 to 1,000 crore from 750 crore in last year. A big jump.
Sounds good so far.
But, critically, there was no change in plant capacity.
Oh. Okay, let's put you in the auditor's shoes again. What's your immediate reaction to that? Where's the extra revenue coming from if capacity hasn't changed?
That's the million-dollar question, isn't it? This immediately flags excessive pressure to be involved in fraudulent financial reporting. There's a strong temptation or pressure to inflate its revenues to show a rosy picture, especially if capacity is constrained. It's a classic fraud risk factor, a major red flag.
So what's the auditor's response then?
Your response would be to increase skepticism and perform specific procedures. Things like detailed, substantive analytical procedures relating to revenue, really digging into that increase. Where did it come from? Which customers? Which products? You might also consider using computer-assisted audit techniques to identify unusual revenue transactions, maybe large, round sum sales right at year-end.
Using tech to find anomalies.
Exactly. And definitely increase testing controls pertaining to revenue transactions and the related substantive testing of revenue itself. This shows how a specific risk factor directly translates into targeted audit work.
Got it. And you mentioned Test Your Understanding 2 earlier as well.
Right, just briefly. That scenario points out that management failing to remedy known significant deficiencies in internal control on a timely basis is a fraud risk factor for misstatements arising from fraudulent financial reporting.
Why is that a risk factor?
Because it suggests an attitude, character, or set of ethical values that allow them knowingly and intentionally to commit a dishonest act. If management knows controls are weak and does nothing, it might indicate a culture where fraud is more likely to occur or be tolerated. It's about the tone at the top again. Now, what happens if things get really bad? If, as a result of identified or suspected fraud, the auditor feels they just can't continue the engagement?
So they just walk away?
It's not quite that simple. It's a serious situation. If the fraud brings the auditor's ability to continue into question, maybe management's integrity is completely compromised, the auditor must first determine the professional and legal responsibilities applicable in the circumstances. What do the standards, laws, or regulations require?
Okay, check the rules first.
Then they have to consider whether it is appropriate to withdraw from the engagement, where withdrawal is legally permitted. Sometimes withdrawal isn't allowed or practical.
Right.
If they do decide to withdraw, they must discuss with the appropriate level of management and those charged with governance, the auditor's withdrawal, and the reasons for it. And finally, they need to determine whether there is a professional or legal requirement to report the withdrawal and the reasons potentially involving fraud to regulatory authorities.
So potentially informing regulators, that's a big step.
It is. Withdrawing isn't taken lightly, but sometimes it's the only option if trust is completely broken.
Throughout this whole process, communication seems absolutely vital, both getting information and giving it.
It is, and that includes getting formal commitments from management. Auditors must obtain written representations from management and, where relevant, those charged with governance.
What do these representations say?
They formally confirm that management acknowledge their responsibility for the design, implementation, and maintenance of internal control to prevent and detect fraud.
Putting it in writing.
Yes, and critically, that they have disclosed to the auditor their knowledge of any allegations of fraud or suspected fraud affecting the entity's financial statements communicated by employees, former employees, analysts, regulators, or others.
So management confirms they've told the auditor everything they know about potential fraud. They can't later claim they weren't asked or didn't know.
Exactly. It's an important piece of audit evidence. Communication also flows from the auditor. If fraud is identified or suspected, it must be communicated on a timely basis to the appropriate level of management.
Who is the appropriate level?
Usually it's the level above those potentially involved, people who have the primary responsibility for preventing and detecting fraud. They need to know so they can take action. And communication must also go to those charged with governance.
The board or audit committee again. When do they need to be told?
They need to be informed on a timely basis if the fraud involves management or employees who have significant roles in internal control, or even others if the fraud results in a material misstatement. Basically, any significant fraud needs to go upstairs.
And what if management itself is suspected?
If the auditor suspects fraud involving management, they must communicate these suspicions directly to those charged with governance. And they need to discuss with them the nature, timing, and extent of audit procedures necessary to complete the audit. This is about getting oversight involved when the people running the show might be implicated. And lastly, there's the potential for communications to regulatory and enforcement authorities.
We touched on this with withdrawal.
Right. The auditor must determine whether there's a responsibility to report the occurrence or suspicion to a party outside the entity. Usually there's a duty of confidentiality.
But sometimes that's overridden.
Yes, it may be overridden by statute, the law, or courts of law. The example given is often in banks, where auditors might have a statutory duty to report fraud directly to regulators like the central bank, RBI, in India.
So legal requirements can trump confidentiality.
They can. And all these communications about fraud to management, governance, regulators, along with the auditor's reasoning if they conclude certain risks aren't applicable, like the revenue recognition fraud risk presumption, must be meticulously documented. That documentation trail is key.
Okay, that covers fraud in depth. But auditors also need to consider the broader legal environment, right? Not just fraud, but all sorts of laws and regulations.
Absolutely. That brings us to SA 250, consideration of laws and regulations in an audit of financial statements.
How do auditors navigate this complex legal landscape? It seems vast.
It is vast, and the effect on the financial statements varies considerably. Some laws and regulations have a direct effect. They actually determine the reported amounts and disclosures. Think about tax laws dictating tax expense or pension laws affecting liabilities.
The numbers are directly impacted.
Right. But many other laws do not have a direct effect on an entity's financial statements in terms of calculating numbers, but compliance is still essential for the business to operate.
Like what? Environmental regulations, labor laws, health and safety.
Exactly. Things like that. Now, while breaking these might not immediately change a balance sheet number, Non-compliance may result in fines, litigation, or other consequences that may have a material effect on the financial statements.
Ah, so even if it's not direct initially, the consequences of non-compliance can hit the financials hard later on. Fines, lawsuits, even potentially shutting down the business.
Precisely. So auditors need to consider both types.
But again, it's important to stress the auditor's role here. They aren't lawyers or compliance officers, right?
Correct. The auditor is not responsible for preventing non-compliance, and because of the inherent limitations of an audit, they cannot be expected to detect non-compliance with all laws and regulations. That would be impossible.
Their focus is on non-compliance that could materially affect the financials.
Exactly. And to help identify such non-compliance, the auditor performs specific procedures.
Like what?
Standard procedures include inquiring of management and those charged with governance as to whether the entity is in compliance with relevant laws and regulations, just asking them directly. They also inspect correspondence, if any, with the relevant licensing or regulatory authorities. Are there any warning letters, notices of violation, fines being discussed?
Looking for external signs of trouble.
Right. It's about maintaining awareness of the legal and regulatory environment the company operates in. Let's look at another scenario. FAS Insurance Brokers Limited, from Test Your Understanding 3.
Okay.
Here, the Director General of GST Intelligence, DGGI, has issued notice to the company for allegedly creating fictitious invoices amounting to 50 crores. GST is a type of tax, and the matter was also informed to IRDI, the insurance regulator.
Okay. Fictitious invoices, tax authorities, regulators. As the auditor, what are your immediate responsibilities here?
This is a very clear indication of non-compliance with laws and regulations, specifically tax laws related to GST. And because it involves potentially huge, fictitious amounts and penalties, such suspected non-compliance may have a direct effect on financial statements.
Right. Potential fines, liabilities, maybe even clawbacks.
Absolutely. So the auditor's response, according to SA 250, is to first obtain an understanding of the nature of the act and the circumstances. What exactly happened? How did it happen? Then they need to evaluate the potential effect on the financials. If management do not provide sufficient information to satisfy the auditor shall consider the need to obtain legal advice.
Get a lawyer's opinion if management isn't forthcoming.
Yes. You're not the legal expert, but you need to understand the legal implications to assess the financial statement impact. And if ultimately sufficient information cannot be obtained, the auditor must evaluate the effect on the auditor's opinion. This could lead to a qualified opinion or even a disclaimer if the potential impact is pervasive.
So it shows how auditors have to react when these legal issues surface during an audit.
Definitely. Now, consider another angle with Test Your Understanding 6, the CANN child labor scenario.
Okay, what happens there?
CANN found that maximum of the labor employed in the plants of the company was child labor, a clear violation of labor laws. But when questioned, management replied that looking into the compliance of such law is outside his scope of financial audit.
Is that an acceptable response from management? Not our problem, Mr. Auditor.
Clearly not. While employing child labor might not directly misstate a number on the balance sheet today, though maybe wages are wrong, this non-compliance is fundamental.
Why fundamental?
Because it may cause the entity to cease operations or call into question the entity's continuance as a going concern. Think about the massive reputational damage, huge potential fines, legal actions, maybe even losing their license to operate. The very survival of the business could be at stake.
So it has a massive indirect effect that becomes potentially material financially.
Exactly. So, if the auditor concludes this non-compliance has a material effect on the financial statements, perhaps requiring significant provisions for fines or disclosures about going concern uncertainty, and management hasn't adequately reflected it, the auditor shall express an adverse or a qualified opinion on the financial statements.
This really highlights that auditors need to consider laws far beyond just tax and accounting rules. It's about the overall legal health and viability of the entity.
That's a good way to put it. Now, reporting and documentation under SA 250. If non-compliance is identified or suspected, how is it reported? Well, non-compliance needs to be reported to those charged with governance, unless the matter is clearly inconsequential. If it seems intentional and material, it must be communicated as soon as practicable.
Get it upstairs quickly.
Yes. And if the auditor suspects management or even governance themselves are involved in the noncompliance, they should communicate to the next higher level of authority within the entity if one exists, like a supervisory board or the main board if it was an audit committee.
What if there's no higher authority or they suspect no action will be taken.
Then the auditor shall consider the need to obtain legal advice about their own responsibilities and potential further actions. Escalation is key. And how does this impact the final auditor's report? If the noncompliance has a material effect on the financial statements and has not been adequately reflected through accounting or disclosure, the auditor shall express a qualified or adverse opinion.
Modified opinion based on the noncompliance.
Correct. Or if the auditor was prevented from obtaining sufficient appropriate audit evidence, maybe management blocked access or information that's a scope limitation. In that case, they'd express a qualified opinion or disclaim an opinion depending on the pervasiveness.
Makes sense. And documentation.
As always, crucial. The auditor shall document identified or suspected noncompliance with laws and regulations and the results of discussion with management and those charged with governance and other parties outside the entity. Keep a clear record of what was found, who was told, and what happened.
Okay, clear communication is obviously a running theme here, which brings us nicely to SA 260. Communication with those charged with governance. This standard seems dedicated entirely to that dialogue.
It is. Effective communication is paramount in auditing, and SA 260 provides the framework for that specific communication channel.
First off, who exactly are those charged with governance? We've used the term a lot.
The standard defines them as the persons or organizations with responsibility for overseeing the strategic direction of the entity and obligations related to the accountability of the entity.
So it could be the board of directors, an audit committee, maybe even owners in smaller companies.
Exactly. It depends on the entity structure. The key is they have that high-level oversight responsibility for financial reporting. They're the ones management reports to and the ones ultimately accountable.
And SA 260 stresses effective two-way communication. Why two-way?
Because it's important in assisting both parties. It helps the auditor obtain information relevant to the audit. Governance often have a strategic perspective management might lack. And it helps those charged with governance fulfill their oversight role by understanding the audit findings and issues.
So it's a dialogue, not just the auditor reporting out. A partnership, almost.
Ideally, yes, built on open communication. And SA 260 lists several key matters to be communicated by the auditor to governance.
What are the main ones?
First, clarifying the auditor's responsibilities in relation to the financial statement audit, making it clear that the auditor forms an opinion, but management is still primarily responsible for preparing the statements. Setting expectations.
Okay.
Second, communicating the planned scope and timing of the audit early on. This helps governance understand the auditor's approach, the key areas of focus, and allows for discussion about risks, materiality, and coordination.
No surprises later.
Exactly. Third, and very important, communicating significant findings from the audit once the work is done or substantially done.
What falls under significant findings?
Several things, like the auditor's views about significant qualitative aspects of the entity's accounting practices, our take on their accounting policies, estimates, disclosures. Are they appropriate, aggressive, conservative? Also, any significant difficulties, if any, encountered during the audit.
Like what kind of difficulties?
Things like unreasonable demands on the auditor by management, significant delays in getting information, restrictions imposed on the auditor by management, or the unavailability of expected information. Governance needs to know if management is making the audit difficult.
Right. That could be a red flag for them, too.
Definitely. Also communicating significant matters arising during the audit that were discussed with management, keeping governance in the loop on important issues, and finally, any circumstances that affect the form and content of the auditor's report, if any.
Such as
if the auditor expects to modify the opinion, or if they plan to include an emphasis of matter paragraph, or identify key audit matters in the report. Again, no surprises in the final report. There's also a very specific requirement under SA 260 for listed entities regarding auditor independence.
What's required there?
For listed companies, the auditor shall communicate with those charged with governance. Two key things. First, a statement that the engagement team have complied with relevant ethical requirements regarding independence, a formal confirmation. And second, they must disclose all relationships and other matters that may reasonably be thought to bear on independence. This includes disclosing the total fees charged for the audit and any non-audit services provided.
Full transparency on independence threats and safeguards. Why is this so stressed for listed entities?
Because public trust in the independence of auditors for listed companies is paramount for the capital markets to function properly. Governance needs this information to make their own assessment of the auditor's independence.
Okay, Let's apply this communication aspect. Test your understanding. 4 features C.A. Vallabhsundar, auditing a bank. He's thinking about reporting the bank's IT systems and controls as a key audit matter, carry am, because they're so complex and crucial. The question is, when should he communicate this intention to those charged with governance?
Good question. The standard says communication should be on a timely basis. What does that mean for CAMs? It means the auditor may communicate preliminary views about key audit matters when discussing the planned scope and timing of the audit, so potentially quite early on.
Give the heads up.
Exactly. And then they'd likely discuss it further when communicating the overall audit findings near the end. Providing a draft of the auditor's report, including the proposed CAM, can be a really useful way to facilitate that discussion before the report is finalized.
So it's an ongoing dialogue, not just a final reveal.
Ideally, yes.
Yeah.
The goal is constructive communication, no surprises.
And linking back to Test Your Understanding 9 briefly, that just reinforces the importance of communicating auditor independence to governance, especially for listed entities, so they can properly assess the auditor's impartiality. It's fundamental to their oversight role.
Absolutely critical for trust and credibility.
Okay, we've covered the core principles: fraud, laws, communication. Let's wrap up by touching on a couple of special audit scenarios that often appear. SA 299 on joint audits and SA 402 regarding service organizations.
Right. These deal with situations where the audit structure or the entity's operations are a bit different. Starting with SA 299, joint audit of financial statements. What is that exactly? It's where more than one auditor firm is appointed to conduct the audit of large entities. These joint auditors work together, conduct the audit jointly, and report on the financial statements.
Why would a company have joint auditors?
Often seen in very large companies, maybe state-owned enterprises, or sometimes mandated by regulation in certain sectors or countries, it can bring broader expertise or capacity.
Okay, so if you have 2 firms auditing together, how is the work divided? And crucially, who's responsible for what? Does it just split the liability 50-50?
That's the key question, and it's not quite a simple split. The standard says the joint auditors shall discuss and develop a joint audit plan. This plan must identify the division of audit areas and common audit areas.
So they agree up front who covers what? Like, firm A takes assets, firm B takes liabilities.
Something like that, yes.
Yep.
Based on materiality, risk, expertise. And the rule is, each joint auditor shall be responsible only for the work allocated to such joint auditor. This includes their individual assessment of risk and controls within their allocated area.
So firm A is responsible for assets, firm B for liabilities in that example.
Yeah, for their allocated work. However, and this is critical, there are specific areas where all the joint auditors shall be jointly and severally responsible.
Jointly and severally, meaning both firms are fully responsible for those areas.
Exactly. Either firm could be held fully liable. These areas include, quote, the audit work which is not divided among the joint auditors, any common areas or unallocated work. Also, decisions taken by all the joint auditors under audit planning in respect of common audit areas, and matters which are brought to the notice of the joint auditors by any one of them and on which there is an agreement among them.
Okay.
Plus, crucially, they are jointly and severally responsible for ensuring that the financial statements comply with the requirements of the relevant statutes, for the overall presentation and disclosure in the financials, and for ensuring that the audit report complies with all the standards.
So, while they divide the detailed testing, they share responsibility for the big picture compliance, presentation, and the final report itself.
Precisely. You can't just blame the other firm if the overall report is wrong or the financials don't comply with the law. And speaking of the report, normally the joint auditors are required to issue common audit report. One single opinion.
But what if they disagree? Can firm A issue a clean opinion and firm B a qualified one?
If they are in disagreement with regard to the opinion or any matters to be included in the report, they shall express their opinion in a separate audit report.
Ah, so you could potentially get 2 different reports.
You could. And if that happens, each report must make reference to the separate audit report issued by the other joint auditors using an other matter paragraph as required by SA 706. So readers are alerted to the disagreement.
Okay, that's fascinating. So in that Test Your Understanding 7 scenario with Magnet Interiors Ltd. and its joint auditors AB & Co. and CD & Co., their responsibilities are a mix of individual and shared.
Exactly that. To summarize, each joint auditor shall be responsible only for the work allocated to such joint auditor, including assessing controls and risks in their areas. But all the joint auditors shall be jointly and severally responsible for undivided work common planning decisions, matters agreed upon, overall statutory compliance, presentation disclosure, and the compliance of the audit report itself. It's a shared burden for the final output.
Got it. And the other special scenario was SA 402, service organizations.
Right. SA 402, audit considerations relating to an entity using a service organization. This applies when the company you're auditing, the user entity, uses an external service organization to perform services that are integral to the entity's business operations.
Like outsourcing payroll processing, or maybe their IT data center, or tax compliance.
Exactly, those kinds of things, where part of the entity's system, including potentially its internal controls, is actually sitting with a third-party provider.
So as the auditor of the user entity, the user auditor, what do you need to do? You can't just ignore the outsourced part, right?
Absolutely not. The user auditor needs to gain an understanding of the services provided by the service organization and their significance, including the effect thereof on the user entity's internal control. How does that outsourced payroll process impact the risk of material misstatement in the user entity's payroll expense?
How do you get that understanding? Do you have to go and audit the service organization yourself?
Not necessarily. That can be inefficient if many auditors need to audit the same service organization. SA 402 allows the user auditor to potentially rely on a report issued by a service auditor.
A service auditor?
Yes, an auditor engaged by the service organization to report on its controls. There are two main types of reports. A Type 1 report describes the service organization system and the design of its controls. A Type 2 report goes further. It describes the system, the design, and operating effectiveness of the controls over a period.
So the Type 2 report gives more assurance because it includes testing of controls.
Exactly. The user auditor can use these Type 1 or Type 2 reports to gain the necessary understanding and, particularly with a Type 2 report, potentially get evidence about the effectiveness of controls at the service organization, reducing the need for their own direct testing.
So it's about leveraging the work done by the service auditor.
Precisely. It's an efficiency mechanism, but the user auditor still needs to evaluate the report, assess its relevance, and determine if it provides sufficient evidence for their own audit.
Right. And that brings us pretty much to the end of our deep dive into general auditing principles and auditors' responsibilities. Wow, we've covered a lot of ground from those foundational essays like 200, 210, 230, to the critical areas of fraud, SA 240, and laws and regulations, SA 250, the importance of communication, SA 260, and even these special scenarios like joint audits, SA 299, and service organizations, SA 402. It's been a really comprehensive journey.
It has. And the aim, remember, was to give you that detailed, terminology-rich review, really showing how these concepts connect and play out in practice, especially in those exam-style questions. Hopefully working through the examples CA, Bejoy's Dilemma, Maya Decor's Revenue Jump, FAS Insurance's Tax Notice, CA Anand and the Labor Laws, CA Vallabh's Sundar, Thinking About Comms, and Magnet Interior's Joint Responsibilities gives you concrete anchors for applying these principles. It's about moving beyond just memorizing definitions to truly understanding how these standards guide an auditor's judgment and actions. These are the tools of the trade.
Absolutely. And that understanding is what builds your professional judgment and that crucial professional skepticism. Those are invaluable skills, not just for the exam, but for analyzing any financial information you encounter. When you see a case study now about, say, a sudden spike in revenue with no explanation, your mind should immediately jump to SA 240, those fraud risk factors, the potential for override.
Exactly. Or if you see complex related party deals, SA 240 and SA 260 should come to mind. If there's a regulatory investigation mentioned, SA 250 kicks in. It's about seeing those connections. So as you reflect on this deep dive, what stands out most to you? How will you take this integrated understanding and apply it to your next practice question, or even when you read about a company in the news? Think about how these standards, woven together, empower auditors, how they help provide that reasonable assurance despite all the challenges, the inherent limitations, the risk of sophisticated fraud, the constant potential for management override of controls. It really underscores what a dynamic, critical role the auditor plays. They're not just checking numbers, they're key guardians of trust and integrity in the whole financial system.
A fantastic point to end on. It really is a critical role. Until next time, keep digging deeper.